Assalamualaikum and a very good morning to our lecturer. Today, our group would like to present financial statement of Pharmaniaga. Before I would like to proceed more, I would like to introduce our members group. First of all, our first member is Asma binti Nordin, Farah Nur Balkis binti Maid, Nurul Nazira Bariah binti Muhammad Saki, Anissa binti Abdul Qudus, and myself Nufazana binti Arifin. Alright, for my part, I would like to present about introduction. What is Pharmaniaga is it? As we know, is Pharmaniaga parent is Bossed Holding, and Pharmaniaga is the largest. It's the proud to be largest integrated pharmaceutical group in Malaysia. And as we know, this company has established a strong reputation as a provider of quality product and services within the healthcare industry. And this Pharmaniaga have own philosophy, which is passion for patient. And then Pharmaniaga scope is, as we know, this business interest in a range of research and developments, manufacturing of generic pharmaceutical products, sales and marketing, as well as logistic and distribution of pharmaceutical product and medical equipment.
Okay, I will proceed with the liquidity ratio. At first, liquidity ratio is defined as to answer the question for the company either has adequate cash flow or asset that near to cash that will be sufficient to meet short-term liabilities of the firm. The liquidity ratio consists of three ratios. The first one is current ratio. Current ratio can be defined as the company's assets that are relatively liquid in nature and match them to the short-term liability of the company. So as you can see for the Pharmaniaga, in year 2017, it has RM 0.78 cent, and for the year 2018 is RM 0.81 cent. It shows the increasing of the company by 0.03. So the result indicates that for every RM 1 ringgit of current liabilities, Pharmaniaga has 0.78 for 2017 and 0.81 in 2018 for their current asset. So the current ratio is below the 1 ringgit, so it shows the current liability was exceed of the current asset. So the Pharmaniaga must concern for the management of the company because current ratio give overview the company operating efficiency. But high ratio indicates safe liquidity, but also can be a signal that the company has problems getting paid in receivable or have long-term inventory that shows the inefficiency of using its current asset. So as a recommendation for the Pharmaniaga, in order to improve the current ratio, Pharmaniaga must increase the sales that can increase cash in hand and account receivable. Second ratio is quick ratio. Quick ratio can be defined as the company's assets that are relatively liquid in nature and match them to the short-term liability of the company without having rely on the sale of inventory and prepaid. So the difference between the current ratio and quick ratio is quick ratio must be deducted with the inventory and prepaid. So for the Pharmaniaga company, for the year 2017, it has RM 0.30 cent, and for the year 2018 is 0.28 cent. It shows the decreasing of the company by 0.02. So the result indicate that for every RM 1 ringgit of current liability, the company has 0.30 for the year 2017 and 0.28 in 2018 by the less of inventories. So it shows that by ignoring the inventories, the company liquid asset will be more insufficient to pay or settle its short-term liability compared to by using the current ratio. As the recommendation for the Pharmaniaga, it will be same like the current ratio. It must improve their sales to improve the cash in hand and account receivable. As last ratio under liquidity ratio is cash ratio. Cash ratio can be defined as the ability of the company to cover all current liability immediately without having to sell or liquidate their asset. So for Pharmaniaga in year 2017, their cash ratio is RM 0.03, but for the 2018, just only 0.25, that increased by 0.22. So the cash ratio was less than, so the result shows that cash ratio was less than RM1 ringgit, that it give a result that the current liability are more than cash and cash equivalent that companies have. So when the company face insufficient cash on hand, it will have a problem to pay off short-term debt. So in order to increase their cash ratio, as our recommendation for Pharmaniaga, Pharmaniaga can skew its balance sheet such as lengthen than normal creditor with its supplier, and efficiently manage inventory, and very little credit extended to its customer in order to increase their cash ratio.
Next, I would like to explain about efficiency ratio. Okay, efficiency ratio can be defined is it is all about provide to the investor with information, ensuring that the business earns sufficient return to its provider of finance, debt, and equity. There are 5 elements under efficiency ratio. Okay, for the first one is inventory turnover ratio. Okay, for inventory turnover ratio can be defined as the relative liquidity of stock in a company as measured by the number of times a company's stock are sold and replaced during the year. Inventory turnover ratio also is to measure of a company's efficiency in turning its inventory into sales. This ratio should be compared against industry average. Okay, for Pharmaniaga company, their inventory turnover ratio for the year 2017 is 4.10 times. Meanwhile, for 2018, their inventory turnover ratio is 2.93 times. From this, we can show it a decrease by 1.17 times. Okay, a lower stock turnover ratio is a signal of inefficiency. It also implies that the firm either has poor sales or has excess inventory. In order to improve the inventory turnover ratio is by having proper plan for improving inventory turnover ratio by concentrating on better sales or by lowering the blockage of funds on a stock. Is average collection period. The average number of days between the date that credit sale were made and the date that the money was received or collected from the customer, or in other words, SCP is an average length of time that the firm must wait until making credit sale before receiving the cash from the creditor. As we can see, SCP for Pharmaniaga in year 2017, it takes 38.75 days to get paid from the creditor. Meanwhile, in 2018, it takes 47 days, which is more longer than in year 2017. From this, we can see that Pharmaniaga average collection period was increased by 8.25 days from 2017 to 2018. So, companies calculate the average collection period to ensure they have enough cash on hand to meet their financial obligation. Okay, low average collection period indicates the organization can collect payments faster. Next, thirdly, total asset turnover, TATO. Okay, TATO can be defined as a ratio to compare the sale of a company to its asset base. The ratio measures the ability of an organization to efficiently produce sales, and it is typically used by third party to evaluate the operation of a business. Ideally, a company with a high total asset turnover ratio can operate with fewer assets that are less efficient competitor, and so require less debt and equity to operate. The result should be a competitively greater return to its shareholder. Okay, for tattoo that indicates that year 2017 it takes 1.45 times, meanwhile in year 2018 there takes 1.25 times, which is more shorter than in year 2017. From this, we can see that Pharmaniaga total asset turnover was decreased by 0.2 times from 2017 to 2018. In 2017, Pharmaniaga being more efficient in bringing more sales from their asset rather than 2018. This because it is a tool to see which firm are making the most use of their asset and to identify weakness in firm. The higher the asset of turnover ratio, the better the company is performing, since higher ratio implies that the company is generating more revenues. Thirdly, for receivable turnover ratio, I think. Okay, the receivable turnover ratio is an accounting measure used to quantify a company's effectiveness in collecting its receivable or money owed by the clients. The ratio shows how well a company use and manage the credit it extends to customer and how quickly that short-term debt is collected or is paid. The receivable turnover ratio is also called the account receivable turnover ratio. Okay, for receivable turnover ratio for Pharmaniaga indicates that the year 2017 it takes 9.42 times. Meanwhile, in year 2018, takes 0.15 times, which is more shortened than in year 2017. From this, we can see that Pharmaniaga receivable turnover was decreased by 9.27 times from 2006 from 2017 to 2018. In 2018, Pharmaniaga being more efficient to collect its receivable. A low receivable turnover ratio might be due to a company having a poor collection periods, bad credit policies, or customers that are not financially viable or creditworthy. Okay, a company receivable turnover ratio should be monitored and tracked to determine if a trend or pattern is developing over time. This is how to maintain a receivable turnover. For efficiency ratio is fixed asset turnover, which is FATO. Okay, FATO usually used by the analysts to measure operating performance. This efficiency ratio compare net sales or income statement to fixed asset balance sheet from balance sheet and measure a company's ability to generate net sales from its fixed asset investment, namely property, plant, and equipment. Okay, for fixed asset turnover ratio in Pharmaniaga company indicates that the year 2017 take 2.80 times, meanwhile in year 2018 it takes 2.81 times, which is more longer than in year 2017. From this, we can see that Pharmaniaga fixed asset turnover ratio was increased by 0.01 times from 2017 to 2018. In 2018, Pharmaniaga utilized its plant and equipment more than 0.01 times rather than in year 2017, which is more efficient, more effectively. Okay, a higher ratio result implies that management is using its fixed asset more effectively. This because a high FATO ratio does not tell anything about company's ability to generate solid profit or cash flow.
The next ratio is leverage ratio. Okay, for leverage ratio is used to measure the source of finance that was used by the company, and they also used to measure to what extent the debt that was used by the company. And then we also, by using leverage ratio, we also want to know on the company capacity in meeting their interest payment obligation. Okay, the first of leverage ratio is debt ratio. Okay, for debt ratio, it is used to measure on how much their total asset can cover up their total liabilities and whether their total asset is enough to cover up their total liability. So, and then debt ratio also want to measure how risk it will be if they continue to adopt debt financing. Okay, for financial year 2017, they use about 66% for their debt, and then for financial year 2018, they use 72%. So from this, we know that there is slightly an increment between 2017 and 2018. And then their debt usage also increased by 6% for 2018. That means they are depend on debt. They are depend too much on debt. About almost 3/4 of their debt ratio is come from debt. Okay, so our recommendation is they must stabilize between their total debt and also their total asset. But still, although their ratio is quite high for 2018 for debt, but they still can meet the obligation to pay their debt. Okay, next is for debt to equity ratio. So for debt and equity ratio, it is to measure the proportion of the debt and also equity used in the company. It's like a comparison between equity and debt that was used by the company. So for equity is the shareholder equity, which is come from the shareholder money, which is capital that was used in the company to fund their business. Okay, for financial year 2017, it showed that they used debt compared to equity about 1.94 times. But for financial year 2018, they increased their debt usage compared to equity for 2.61 times. So there is an increment of their debt usage, but it's not too good as they are too depend on debt. So when they are too depend on debt, there will be a possibility of liquidation if they are failed to pay the debt. But that also not necessarily a bad decision. Still, that also not a bad decision. Because when they are too depend on equity, it also can give a bad effect to the company as they have to pay dividend to their shareholders. So our recommendation for debt to equity ratio, how they want to improve their debt to equity ratio is by they improve their total equity by issue a new share to the public. So when they issue new share to the public will subscribe new share to their company. So when their total equity increase, then their debt to equity ratio also will be stable. Okay, lastly, the leverage ratio is for time interest earn ratio. Okay, so for time interest earn ratio, it is used to evaluate the ability of the firm to meet or to satisfy their interest payment obligation. So it is to use how the company able or not to pay their interest obligation by look at their earning before interest and tax. Okay, so for financial year 2017, the ratio is 2.49 times, but in financial year 2018, the ratio is 1.90 times. So as you can see, they are slightly decreasing their ratio of the time interest earned. So that means that the ability for the company to meet their increased payment is decreasing. So for our recommendation is the company, they need, before they make a decision to enter into a loan contract or enter into the debt financing contract, they need to do some research to know whether the company, whether or the bank institution or the creditors offer them with a short interest. They need to find the lowest amount of interest offer as it will help them to meet their interest payment obligation.
The last ratio is profitability ratio. It is mean that the company can generate adequate profit from the use of its capital and assets. It gives you to the company that for every revenue earned by the company, from deducting the cost incurred, the company have the ability to sustain its growth, and also it helps the company to determine the profit to shareholder, and also can determine the company overall efficiency. The first ratio in profitability ratio is a gross profit margin. Gross profit margin can be known as a ratio that controls the cost of the goods sold based on how much the company earns of its revenue. And for the Pharmaniaga, in year 2017, the gross profit margin is about 14.42%. Meanwhile, in 2018 is about 13.5%. The company issues that the company faced downgrades for about 0.92% on its raw revenue, which is it showed a decreasing ability of the company after pay for other cost associates, and also issue that the company able to cover the cost of a good sold for every RM1 ringgit earned based on the ratio for both years. And more, revenue earned is higher than the cost of goods sold for both years, which show the positive gross profit margin. But the company is still unable to increase the gross profit margin before deducting other expenses incurred, even the revenue is much higher than the cost of goods sold. And for the recommendations, the company can enhance the gross of the profit margin through well-utilize the non-product cost per unit produced in a specified time, so there will be no other excess cost included. The second ratio in profitability ratio is operating profit margin. The purpose of the ratio is to measure the productivity of asset in providing returns to both creditors and stakeholders. Moreover, operating profit can be obtained from calculating the number of the product produced, a price per product, in direct and indirect costs, and also the other operating expenses such as administrating costs, manufacturing and distributing costs. For the year 2017, the company, the Pharmaniaga, able to gain its operating profit margin for about 14.4%. Meanwhile, for year 2018 is about 13.5%. It shows that the Pharmaniaga is going through decreasing trend for about 0.92%. However, the Pharmaniaga able to manage the cost driver of the operating profit, such as operating, distributing, and administrative costs. And also the company is still able to cover the cost based on the ratio for the both year. For the recommendation, the company need to lower its cost of goods sold and also the other cost associates, and also increasing the selling price per product or amount of the products sold within a specified time to increase the operating profit margin. The third ratio in this ratio is net profit margins. Net profit margin can be defined as the income that obtained after gross profit margin deducting the corporation tax, including other expenses, which is interest expenses, operating expenses, and admin expenses. It can also define as indicate how much the revenue earned for the company after expenses being paid. For the year 2017, the company gained for about 3.42%, meanwhile 2.27% for the year 2018. It indicates the low. It shows that the company having depreciation amount for the comparison of the both year for about 1.50%. It indicates the low stability of the company's financial performance to secure its management. And also, from net profit margin, the company able to determine the value for the shareholder dividend and also for the company investments. And also, the shareholder dividend can be determined through for every RM1 ringgit earned, the company can gain for about 3.42% for year 2017, and for the year 2018, which is for about 2.27%. For the recommendations, the company can play active monitoring the uncertain economic conditions or the slow movement of the computing industry, as if not, it will lead to the ongoing negative net profit margin. The ratio is a return on asset. The purpose of the ratio is to identify the overall return based on the all investment of the assets. It's also to measure the profitability of the company based on its current asset and also non-current asset to finance the company performance. In year 2017, the Pharmaniaga gained for about 3.42% of its written assets, and meanwhile for year 2018, it's gained for about 2.27%. The differences exist is amounted to 1.15%, which shows a declining of the company profits from its asset investments. And also, from that, it could promise higher return on asset to the company because the decreasing is occur might due to the total assets available doesn't reach the maximum level of the quantity and quality. And then for the recommendation for Pharmaniaga, it is encouraged Pharmaniaga to have the higher investment of the inventories and the product produced with high quality, to increase the account receivable of the company using the sophisticated machinery to support the total asset income. For the last ratio in this profitability ratio is a return on equity. The purpose of this ratio is to analyze the rate of the returns of the common stockholders' investments, and also it can be as a mean as the return on the net assets after the company invests its assets. And also, the purpose of the ratio is to evaluate on how many percentage of the income that they can generate from their shareholder equity, and also to determine the efficiency for the company use their shareholder equity. For Pharmaniaga, based on the financial year 2017, the company able to gain for about 10.06%. Meanwhile, in year 2018, the company gained for about 8.48%. It shows that the Pharmaniaga facing downgrade for about 1.62%, which is it indicates the return of equity is decreasing compared to the last years. The amount of income that they could generate from the company common stockholders investment is getting lower. For the recommendations, the company need to fully utilize their shareholders equity so they can generate more income from it. And also, if the company will utilize the shareholder equity, the company can improve the asset turnover.